Hi, good afternoon or possibly good morning. I want to welcome everybody to our webinar today where we're going to be talking about a little bit different type of real estate investing. So many of the webinars and classes we do are centered on maybe a single-family home rental or single-family rehab properties or lending the money to somebody else who's buying more of a single-family home. And we're going to switch gears a little bit today. We have a great guest presenter we're going to bring on in a few minutes to talk more about other types of investments you can make in real estate that really go beyond that single-family home and maybe make you part of a much larger pool of investors for a particular project. Now, as we go through the webinar today, to invite anyone who has any questions, please type those questions into your chat box on the screen. If you are listening to the recorded version of this webinar, you can certainly reach out to myself or to the guest host and guest presenter with their contact information as well. But for anyone listening live, you'll have the opportunity just to ask questions, put them in the chat box. We'll make sure we get to them during today's webinar. My name is Scott Maurer. I'm the Director of Business Development for Advanta IRA. I've been with the company for a number of years, started out primarily helping people with the investments, whether it's single-family home or investing into a private placement. My role originally was to help people through that process, opening up the account, and then making that particular investment. I've spent the last several years, though, really focusing more on business development side, doing speaking engagements and teaching people about self-direction and what is possible and what you can do with your IRA. That's something most people don't know about. Now, a quick disclaimer, at Advanta, we provide a lot of educational opportunities through our webinars and our seminars that we do, but we don't give any legal, tax, or investment advice to our clients, and we certainly do not endorse any products, and we're not affiliated with any other company, and that includes any companies that are part of some of the webinars that we do. We provide this as purely an educational webinar. Anyone looking to make investments are always encouraged to do your due diligence on the investments that you're looking at making, as well as the people you're looking at investing with. If you need referrals to an attorney, to an accountant, someone to give you maybe some advice, we can certainly do that. We'll make you aware of some potential issues, but we cannot really make that final determination for you as the accounts are self-directed. Now, anyone who's not familiar with Advanta IRA, just a little bit of background on our company. We've been in the industry for a number of years now. We have over $1 billion in assets under management, over 6,000 active accounts that we administer. Again, we are not a broker-dealer, so we're not holding mutual funds and stocks. So 6,000 clients and over $1 billion in assets are all non-traditional investments, which we'll talk about in just a moment. Our benefits to our clients, we appoint every new client to a specific account manager that gives you one point of contact for anything you need regarding your account. That personal touch, I know, has made a difference for a lot of people who've chosen us as their self-directed administrator and appreciate that one-on-one attention. In addition to our customer service, we also like to set ourselves apart a little bit when it comes to the education that we offer. Obviously, today's webinar is part of that belief system that we have, and giving as much information as possible to both our clients and non-clients alike, whether it's, again, it's real estate related, whether we're talking about homes, private lending, in this case today talking more of a little bit more in the private placement type arena. But we like to provide that information so people can be at least exposed to different ideas and get some different guidance when considering different types of assets. We do that through our live seminars at our offices in Tampa and Atlanta. Also, obviously the live webinars that you're listening to today. And we have all of our past webinars recorded and placed on our on-demand channel on YouTube. So you can go back at your convenience, click through the videos, and find one on a topic particular that you're looking to learn more about. Now, for some of you on the call, if you're not familiar with self-directed IRAs, or kind of maybe you are familiar, but why hadn't you heard about this before, either today or more recently? The most likely reason most people do not know about a self-directed IRA is simply that most individuals who have an IRA account have it with a bank or a brokerage firm who's offering them mutual funds, stocks, bonds, CD accounts, etc. Those companies are not interested in holding alternative assets. That doesn't fit their business model. They want to hold and sell those products that they earn commissions on or get other fees for. That's, again, mutual funds and stocks, which are easier to hold. IRS, though, the IRS, when it comes to IRA investments and what you can and can't do within a particular account, allow you to invest in a very broad range of investments. So it's not the IRS that's saying to individuals you can't buy real estate in your Fidelity account. It's Fidelity making the decision as the broker that they don't want to hold that type of asset. So it's up to companies like ourselves who are willing to hold these alternative assets within a retirement portfolio. Again, today's presentation is primarily real estate driven, so here's some examples of real estate related assets that we hold here at Advanta that you can invest in using a check or self-directed IRA account. Single family homes, as I mentioned, we do a lot of educational events on this topic. You can again check our YouTube page for those. Whether it's a long-term rental, a short-term rental, an Airbnb, a rehab, you can certainly own those types of assets in your IRA account. Investing in private notes and mortgages where your IRA is acting as a bank for somebody else. And again, that type of webinar we have on our YouTube on demand channel that is full hour just on notes and mortgages alone. Mobile home parks, checkbook control LLCs, tax liens, and a couple different things we are going to talk about today. Again, mentioned we usually talk about single family homes, but we're going to be talking today, and our guest presenter is going to be talking about REITs, real estate investment trusts, or syndications and private placements where one person is putting together, or a company is putting together an investment opportunity, and it's not your IRA buying its own individual property, but your IRA being maybe one of several different members, and in case of some of the REITs, probably thousands of different members in a particular investment. So again, the common thread that all of these assets have is that a brokerage firm typically will not hold those assets. In fact, when it comes to real estate, they pretty much all stay away from it. You might find that some of these assets, every now and then a brokerage firm will take. I know some of the publicly traded REITs, you can certainly get through that type of an account, but we'll talk about that a little bit more as we go forward. So in considering those types of assets that you can purchase, why do people choose to self-direct? For some, it's a new source of capital. The money in their IRA account simply is providing them with the cash for an investment. So if you're looking at investing in a syndication, or you're looking at buying that house down the street, your IRA has the cash for you to make the investment. You maybe don't want to touch your savings account. You'd rather just use money from your IRA that you weren't planning on touching for a while anyway, and that becomes the avenue from what you look to do. A lot of individuals are just tired of the stock market. The roller coaster ups and downs, not sure how to time the market, or not interested in trying to figure out how to time the market anymore. These other assets provide you a different way to invest your IRA funds. And for some, it's a tax benefit. When your IRA, it makes an investment into real estate, or if it's making money into a private placement, the earnings on those investments come back to your IRA account completely tax-deferred or tax-free, depending on the type of IRA that you have. So if you're looking at an investment that has a very large return, and you're already in a high tax bracket, that could be a good opportunity to make that investment through an IRA account and then not have any tax consequences to you because that is all flowing back into your IRA account. Now, for people who are maybe on the other side, certainly if you have an IRA, there's benefits to investing your own IRA into products. But what about individuals who either don't have IRAs or are looking for capital? Why are self-directed IRAs a good capital source? And I think for some, it's a matter of getting repeat investors. If you already have people who are working with you who are investing personally, they're investing through their savings, they're investing through a trust, their IRA can simply invest as well alongside. So if you're raising capital, you can go to your existing group of investors and simply offer them the ability to use their IRA to make that investment. And as I touched on a minute ago, if you're looking to make an investment that has a 5, maybe 10, 15-year life and term, that investment you might not mind doing in your IRA account because you weren't planning on touching that money anyway until you reach retirement. So it's the opportunity to make that investment with your IRA account instead of, again, using your savings or using a rainy day fund when you're trying to access those funds. Sometimes the private placements might offer you a better rate of return, and also if you're offering that rate of return and you're the one raising the capital, people have their money sitting in a CD or a money market afraid of the stock market. You can provide them that good alternative, and there's no outside approval needed. An IRA owner simply is the one that makes the decision. I want to make the investment. I'll use my IRA to do it and get that process started. Now, the accounts that can be self-directed, any type of IRA, traditional, Roth, SEP, or simple, can be pushed over and rolled over into a self-directed IRA account. So if you're wondering if your funds qualify, if it has the designation IRA on your account statement, then you certainly can self-direct those funds. Another large portion of funds that people choose to self-direct are those old 401ks, those old 403b, those qualified plans from an old employer that someone built up over a number of years. They left that firm. They're no longer working there, but they just haven't really done anything with that account. And they're looking to actually start using that money in some form or fashion. Any old employer's plan can be used as well. And also defined benefit plans or solo 401ks we offer as well. The only plan, sometimes there's some restrictions on being able to move it, is any current employer's plan. As long as you're employed with a company, they can restrict your ability to move that money. And how does the money get moved? It's either by transfer or direct rollover. It just depends on where your funds are currently sitting to decide whether it needs to be a trustee-to-trustee transfer from IRA to IRA, or whether it's a direct rollover from an employer-sponsored plan to that self-directed IRA. Either way, it's a non-taxable movement of money, and you can do transfers and direct rollovers as often as you'd wish. As long as you don't touch the money personally, there is no restriction on making those transfers or direct rollovers. So how does it work if you're looking at investing in a private placement? We'll just go through a very quick case study because I want to get our guest presenter on here in just a moment. So we have Jane, who has over $100,000 sitting in her Vanguard IRA, and she runs into Randy, someone who has this private offering. They're going to be purchasing and then remodeling an apartment complex. Randy needs, maybe a few $1,000,000 to actually purchase that property and get the remodel process started. So he's offering individuals ways to subscribe because he doesn't have that $2 or $3 million up front personally, and he knows it's difficult to find maybe an investor or that has that amount of money. So he can actually look for maybe a couple people to put in some of their money towards that private placement. When Randy forms his company and forms his offering, there'll be a subscription document. There'll be a prospectus that outlines the details of what Randy is looking to do with the apartment complex. So it's up to Jane to review that document and read through it and make sure she is comfortable with that particular investment, all the risks and the potential rewards that investment offers. Jane is going to work with Advanta to open up her self-directed IRA account, actually going through the paperwork to get an IRA established, and then get $100,000 transferred from her Vanguard IRA, again tax-free, over to her Advanta account. We'll work with her on every step of that process, and we'll submit that transfer form to Vanguard and notify her when those funds arrive. Now, Jane will be appointed to an account manager here at Advanta, one person who will work with her through all the investment documents. Again, we'll want to make sure that Jane approves the documents, number one, and also that the subscriber is listed as Jane's IRA account. So if you're making an investment, and this goes for any type of self-directed asset, the owner, in this case the subscriber's name, needs to be the name of your IRA account, and you can see the wording there, Advanta IRA for benefit of Jane's IRA account and her account number, and also the tax ID number used on those documents will be Advanta's trust tax ID as well, not Jane's social. We want any tax reporting that entity has for the dividends, the distributions that it pays out, being reported to our trust tax ID, not her social. That keeps the investment, again, tax protected for Jane. Once she's approved the documents, once they're appropriately titled, we will sign the subscription documents and then send the wire to the fund. And any future dividends, profits are then just deposited back into Jane's IRA. It's not taxable to her. It's not included in her income. And then when she exits the investment as well, or the investment is sold, the proceeds come back to her IRA, again, with no tax consequence to Jane. So from a tax perspective, this is tax neutral to her. There's no repercussions whatsoever to Jane on a personal basis. And obviously she's opened up her IRA as a different type of, open up her IRA to a different type of an investment within her account. Now at this time I want to bring on our guest presenter who's going to talk a little bit more specifically about these types of investments, these private placements, and a couple different things you can do outside of the single-family home. So Chris Geer with 4 Mile Capital, we invited Chris in today to share his knowledge on these different types of investments. This time, Chris, I'll turn it over to you and go ahead and share your screen and show your slides.
Okay, great. Thanks, Scott. I am working on the screen share now. Let me know when it comes up on your end.
Yeah, it's coming up now, and as Chris gets it going, I'll just remind everyone, as you have questions for today's webinar and going through it, please type those questions into the chat box on your screen. We'll make sure we get those questions answered either during the presentation or towards the end as well. But Chris, the screen is up and you're ready to go.
Okay, great. Thanks, Scott, and thanks to each of you for joining us to hear my and Scott's presentations today. In the next 30 minutes or so, I'm going to run through 4 common types of real estate investments. But before we dive into the meat of the presentation, let me take just a quick minute or two to tell you about myself and my company, 4 Mile Capital. As Scott said, my name is Chris Geer, and I am one of 3 partners at 4 Mile Capital. To give you a little background on me, I started my career as a corporate attorney doing mergers and acquisitions and corporate financings. I then went in-house with a client who was a real estate company and ultimately founded my first real estate firm in 2008. That firm was a property management company that I grew at our peak to about 10,000 residential units and 1 million square feet of commercial space under management. In 2014, while I still owned the property management company, I began doing real estate sponsor and acquisition work. In 2016, I ended up selling the management company to form 4 Mile Capital, where we focus on real estate acquisition and asset management. Combined with my partners, Eric Mallon and Terry Simone, we possess about 55 years of real estate experience across multiple real estate asset classes. We primarily focus on multifamily or apartment properties, as we have managed and or owned over 20,000 units during the course of our careers. That real estate represents over $1 billion in real estate value. If you'd like to learn more about 4 Mile Capital, please visit our website. With the background about me out of the way, I'm now going to give you a quick roadmap for the presentation. As I briefly touched on, I'm going to discuss 4 specific types of real estate investments. The first investment I will discuss is publicly traded REITs. The second is private real estate funds. The third is single deal syndications. And the fourth is single asset direct investment. To help create a more linear path for this presentation, I'm going to start with the most passive investments and work my way down through the list until we get to the most active investments. For purposes of this presentation, a passive investment means that you as the investor have less work to do than if it was a more active investment. For each of the 4 types of investments, I'm going to touch on 3 topics. The first is your role as an investor. Here we're going to talk about what you have to do before making the investment and what you have to do after the investment is made to ensure it is successful. Your role is also what defines the investment as passive or active for purposes of this presentation. The second topic I will cover for each investment is fee structures and returns. Here I will go over at a high level the fees that are typical to each investment type, and I will also discuss typical investor returns. Third, I will discuss what I see as the pros and cons of each investment type. Now that we have our roadmap in place, let's turn to our first investment type, publicly traded REITs. So what is a REIT? The term REIT is an acronym that stands for Real Estate Investment Trust. Given that definition adds little clarity to what a REIT actually is, let me break it down for you a bit further. While there are several types of REITs, the kind of REIT I'm going to discuss today is a REIT that is a publicly traded company that purchases hundreds or even thousands of real estate properties and aggregates them together in one investment vehicle. Investors buy shares in REITs on public stock exchanges. Just like you can buy stock in Apple or Microsoft and own a piece of those companies, investors who buy shares of stock in a REIT will own a piece of the REIT, which in turn owns many pieces of real estate. In effect, then, when you buy a share of stock in a REIT, you are buying a fractional ownership interest in each piece of real estate the REIT owns. It is also worth noting that publicly traded REITs are required to distribute a minimum of 90% of their taxable earnings as dividends, making REITs an attractive investment for investors seeking annual cash dividends. That's not as applicable for those of you that are investing through an IRA, but it is worth noting just kind of as a general talking point for this presentation. So now let's dive into your role. Your role when investing in a REIT begins by determining the asset class you want to invest in. There is a REIT for pretty much any asset class, and you of course can choose to invest in more than one type of asset. Common REIT assets include apartments, office buildings, retail properties, industrial buildings, and even single-family homes. Once you've determined the asset class or classes you wish to invest in via a REIT, it is time to research specific REITs. More than 225 REITs trade on one of the major U.S. stock exchanges, and the majority of those trade on the New York Stock Exchange. Because REITs are publicly traded, you can easily access information on a REIT's past performance, strategy, and projected returns, as well as which REITs have performed the best and which have performed the worst in both recent and distant history. So let's now turn to REIT fee structures. To supplement this portion of the presentation, I looked up Blackstone and Starwood, two relatively well-known REITs, to see what they charge. The table on this page shows their fee structure for two specific share types. We will get into what carried interest and preferred return mean a little later in the presentation for those of you who are not familiar with those terms. But note that REITs have a 5% preferred return and a 12.5% carried interest. Additional fees that REITs charge include a 3.5% sales commission that is charged on the amount of your investment. So if you invested $100 in a REIT, they would take a fee of $3.50 when you make that investment. And an annual servicing fee of 0.85% of the amount of your investment. So again, if you had $100 in a REIT investment, each year they would take 85 cents as a management fee out of that $100. So now let's take a look at typical REIT returns. One of the great things about investing in publicly traded REITs, as I touched on earlier, is their returns are made available to the public for you to review. Turning to the chart on your screen, we see that as a whole, publicly traded REITs average between 11% and 12.5% annual returns from 2000 to 2015. The worst year averaged just over 3%, and the best year averaged just over 19%. Unfortunately, this chart also shows how returns for publicly traded REITs have compressed since the end of 2012. Now let's take a quick look at the pros of investing in REITs. First, your investment is totally liquid. You can sell your shares anytime. This is very different from the other different types of real estate investments that we're going to talk about today, where your investment is pretty illiquid. Second, information is publicly available, so you can do lots of research. REITs are also directly regulated by the SEC, giving investors direct governmental oversight of their investment. Third, of each of the four investment types we're going to discuss today, you get the best diversification with REITs. This is because you're diversified among many properties in many, many markets. Further, if you invest in several different REITs, you can diversify even more by choosing REITs that invest in different asset types. By so doing, you can diversify not only geographically, but also among different real estate sectors. In addition, you could take $100 and invest it in one REIT, and $100 in another, and $100 in another, and your $300 is going to be very well diversified versus the other types of investments that we're going to discuss today, where you're going to have much more concentration, especially as we get into the more active types of investments.
Hey, Chris, if I don't mind, if I can jump in really quick before we go into the cons. Quick question: you had shown that chart on the fees, or I'm sorry, not the fees, the returns. Generally speaking, for REITs, the average 11 to 12.5. The question someone has asked is that net of fees, or is that the gross return?
My understanding is that this is net of fees.
Okay, so that's after the annual servicing and management fees have been paid.
That's correct.
Okay, yeah, again, reminder, anyone else who's listening, you have questions as Chris goes through, just please type those questions in the chat box and we'll make sure we get them answered. But Chris, I'm sorry, I just want to make sure I pop that in before we got too far past it.
Yeah, no problem, Scott. And I cannot see the questions coming in on my screen, so feel free to interrupt if there's something that we should touch on before I move on to something else.
Okay, well, no problem.
Great, thanks. All right, so now let's take a look at the cons of investing in REITs. On the flip side, there's a trade-off you make when investing in a publicly traded REIT. In exchange for great liquidity and diversification, you give up upside. A REIT portfolio may have some properties that return 30% or more, but others that lose money, netting more modest returns than if you had just invested in one home run or one great real estate investment. In addition, you as the investor have no control over what specific properties the REIT buys. The REIT employees make those decisions, and you have to trust that they will buy good properties. You therefore invest in the REIT managers and operators, not specific real estate assets. Another con with respect to REITs is their performance is not just based on the performance of the underlying real estate, but can also rise and fall with the broader markets. Because they're publicly traded, even though the underlying real estate may be exceeding performance, if the stock market is suffering broadly, returns may still be pushed down. Last, as I recently touched on, REIT returns have slowly edged lower from 2000 to 2015, ending 2015 with only 5 to 6% average returns. So that wraps up our discussion on REITs, and now let's turn to our second of 4 real estate investment types, unless there's a question.
Yeah, Chris, let me jump in on a question. Just curious, you said the REIT returns generally are trending downward. Do you have any kind of insight as to why that's occurring? I mean, obviously, and I understand, I guess, the stock market swings that where people just get out of any, people start getting out of any type of, publicly traded asset kind of thing and going to cash. Is that why the REITs suffer there as well? I guess there's 2 questions, and I guess, is that the reason why when the stock market, even though the real estate's a good investment and it's solid, it's performing, people just kind of sell off, not necessarily in a panic, but just to protect themselves? And also, kind of maybe why do you think the REIT returns are trending downward?
Yeah, my sense is that REITs returns are trending downward specifically because there's a lot of competition out there to buy real estate right now, and REITs have to put capital to work, so they may have to pay more money for an asset than a fund or a sponsor like us or an individual buying a property would, because they have to pay up and make those purchases. So they're really restricted. It's hard for them to find off-market transactions, so they're basically going through a listed brokerage process every time, and in so doing, the price gets bid up. And when the price gets bid up, returns get compressed. And there has been a significant amount of equity that has flooded the U.S. real estate market in the last, I would say, probably 5 to 8 years, because as investors started to seek safer, more secure assets following the Great Recession, U.S. real estate seemed like a great place to put money, and as a result, a ton of equity capital has come into the U.S. real estate market, which has created more competition. And REITs are really, they're in the worst position to uncover unique deals because they have to buy a lot of deals and they don't have time to try to uncover them on their own. So they're really stuck with finding stuff that's listed by brokers, which is sometimes that's a great way to buy real estate, and other times, more often than not, that's actually the most expensive way to buy real estate is to do it when it's been listed by a broker.
Sure. We had one other quick question that popped up. It says, as interest rates rise, will that likely equate to reduced likelihood for returns? Like, rising interest rates, how do you think that would impact a little bit the REIT returns?
So that's a great question, and that's the number one question on everybody's mind who's a real estate investor right now. And there's a couple different things that play into the response. So first of all, if interest rates are rising, it's going to make buying a home more expensive because you're going to have to pay more interest on your home loan. What that means is less and less people are going to be able to afford buying a home, so they're going to continue to rent real estate. And I guess I'm speaking specifically to multifamily properties as in this part of the discussion, and I'll touch more broadly on commercial and industrial as well. So looking at multifamily properties or apartment complexes, it could wind up being that more people are pushed out of the single-family ownership market and are pushed into apartments. And as a result, that's going to create more demand for apartments and is going to increase rates, rental rates. And as rental rates increase, the values of the property are going to increase. So that is, I guess, one side of the coin. On the other side, it's really all about supply and demand with real estate. So long as real estate remains a safe investment class and there's demand for it, regardless of the asset type, you're still going to see returns. I think returns are going to level out at some point. So could rising interest rates hurt real estate returns? Absolutely, but if there still remains demand for those assets from a tenant base, and you still have a strong economy where people are leasing office space and people are leasing industrial space and retail store frontage and apartments, then your returns are not going to be, they're not going to suffer in any measurable way, because when you ultimately exit the real estate by selling it, you're still going to have strong values because of the demand for the property.
Okay. All right. Well, thanks for the answer. I don't have any questions at the moment that popped up since then, so I'll let you kind of get on to the next investment type.
Okay, great. So the next investment type, number 2 out of 4, is private real estate funds. Private real estate funds are like REITs in that they buy multiple pieces of real estate with 2 distinct differences. First, they are generally much smaller, ranging in size from 20 million to several billion. And second, they are not publicly traded. And that's probably the biggest difference, is that this is a private investment, not something that you can go on to a publicly traded stock exchange and buy a piece of. There are 2 primary types of private real estate funds. The first is direct investment funds, and the second is sponsor investment funds. Direct investment funds buy real estate directly and hold the assets in a fund. The upside to this type of fund is there is no middleman taking fees, theoretically allowing for more profits to be distributed to investors. I'll explain the middleman structure a little bit further on the next slide, but just kind of keep a placeholder for that for now. The downside is the funds don't have anyone on the ground who specializes in a market, which can lead to less local knowledge and expertise. And given that real estate is a very local investment, therefore that can create more risk in the investment decisions the fund makes. Sponsor investment funds, on the other hand, use a sponsor to identify real estate opportunities. The sponsor then presents the opportunities to the fund, and the fund uses the sponsor's research and knowledge of the specific asset and the surrounding market to make an investment decision. Funds also supplement the sponsor's work with their own underwriting. The upside to using a sponsor is the sponsor, either because they live in the market or because they have researched it extensively, knows the market and the real estate in that market very well, and likely better than the fund. This helps sponsor investment funds decrease risk. The trade-off for that decreased risk, however, is that you can have decreased returns. In this structure, the fund is taking a fee, in essence acting as the middleman between you and the sponsor, and given the sponsor is taking a fee as well, that means that there could be less profit for investors. So what would happen with you as an investor, you would invest in the fund, and then the fund would go out and use a sponsor to find deals. The sponsor gets paid a fee by the fund, and then you pay a fee to the fund, and then ultimately you get your returns. I say that theoretically you could pay more in fees and therefore have decreased returns in this structure, because in many cases sponsors can increase returns through better market knowledge and also through uncovering better deals. So your overall return has the potential to be as good as, if not better than, direct investment funds, despite the additional fees. So what is your role as an investor who is considering investing in a private real estate fund? As is true with REITs, you have to research private real estate funds. All funds have a website, so that is a good place to start. If you like what you see on the website, then you should contact the fund directly. Some key questions to ask are, what is the fund's history and track record? What is the fund's investment thesis? i.e., what asset classes do they invest in? What markets do they invest in, and why? What are their projected returns and fee structures? And you're just going to want to get to know the fund ownership and management pretty well if you can. These investors are more active because you have to do more digging. Unlike with a REIT, information about private real estate funds is not publicly available for your consumption. So in order to get all the information you need to determine if you want to invest in a fund, you not only have to request the information directly from the fund, but you also have to know what questions to ask. And I think that's really the trickiest part about investing in anything other than a REIT, where the information is all just out there and available, and you can read anything and everything that you want about the REITs and their investments. So let's take a quick look at the fees a private real estate fund charges. Though each fund structure can vary, the most common structure is what is called a 2 and 20 fee structure with a preferred return. What this means is the fund is paid a flat 2% asset management fee annually, so that's the 2 and the 2 and 20, then receives a 20% carried interest, that's the 20 in the 2 and 20, after investors are paid a 6 to 9% preferred return. Because not everyone is going to be familiar with these terms, let's take a minute to explore these fees and how they are calculated. In a fund, the asset management fee is a fixed fee charged annually. Typically, it is charged in one of two ways. The first way is for it to be charged on the equity in the fund. So if the fund has invested $100 million and the fee is 2%, it would receive a fee of $2 million per year. The second way an asset management fee can be charged is on the value of the assets in the fund. In this case, if the fund used $100 million in equity to buy $400 million in real estate, the way they do that is using 75% debt as the capital to purchase each asset that it buys, then it would charge 2% on $400 million or $8 million a year. This means that asset-based asset management fees can be much higher than equity-based asset management fees. So you need to carefully examine how this fee is charged. That said, every fund has its own little nuances to its structure and how it charges fees. So it's important to really dig in and understand what those fees are and what they're used for at the fund. Generally speaking, asset management fees are used to pay the salaries of the team that is working at the fund, and so you should just take a look at that and understand how they're allocating those fees. So next, let's take a quick look at carried interest and what that is. Carried interest is simply the percentage of profits above the preferred return that the fund will make. There are two types of carried interest, single tier and waterfall. In single tier, once investors receive a predetermined preferred return, the remaining profits are split between the fund and the investors, with a defined percentage going to investors and the remaining percentage going to the fund. In a 2 and 20 structure, the 20 represents the fund's share of profits, meaning 80% of the profits above the preferred return go to investors and 20% of the profits above the preferred return go to the fund. A waterfall carried interest structure is a little more complicated. In this structure, the fund's percentage of profits increases as investors achieve certain return thresholds called hurdles. Hurdles are determined by investor IRR. In the example on your screen, the fund receives a 20% carried interest, or 20% of the profits, until the investor achieves a 14% IRR. Then the fund receives 30% of all profits until the investors achieve a 17% IRR. Once investors hit a 17% IRR, the fund will receive 40 to 50% of all remaining profits, and it'll be one or the other. They won't have a choice. In the fund documents, it will say what percentage of the returns above 17% the fund will take. The carried interest structure is different for each fund, but as noted earlier, funds stick with a fairly simple 2 and 20 structure, I would say the majority of the time. There's some funds that might do a 1 or a 1.5 and 25, but 2 and 20 is kind of the baseline. So the last concept I'll talk to you about today with respect to fund fees is the preferred return. The preferred return is a predetermined percentage return that investors must receive before the fund can receive any carried interest payments. Fund preferred returns are typically 6 to 9%. And I would say on average they're probably 6 to 7. But let's assume, for example, a fund has an 8% preferred return. What this means is investors must achieve an 8% IRR on their investment before the fund will receive any payment for the carried interest. The fund will still make its asset management fee, but will get no carried interest until the 8% IRR has been paid to investors. And funds are really highly incentivized to make sure that they get the carried interest because that's where the majority of their capital and their profits are going to come from. So it aligns the fund with investors, and that's why this profit sharing concept called a carried interest was originally developed. So touching briefly on returns, private real estate fund investors should expect to achieve returns that are at least 2 to 3% above the returns that they would make in a REIT. Today, if REIT returns are holding in that 5 to 6% that they were in 2015, and sorry, I couldn't easily collect data to get us through 2018, but let's assume that they were 5 to 6% still today in a REIT, then you should expect returns of at least 7 to 10% in a private fund. A lot of funds that I know of that are out there today are offering, or I guess marketing, something in the neighborhood of a 13% return to investors. But again, each fund is going to vary pretty drastically. So let's get into a few of the pros and cons of investing in private real estate funds. Starting with the pros, first, you will generally achieve better returns than you will in a REIT. Second, you still have solid diversification as funds will invest in multiple assets and typically in multiple markets. Third, investors can develop personal relationships with people at the fund, which can create more trust and confidence than what you can have with a REIT. Last, and unlike REITs, private funds are not directly affected by swings in the public securities markets. Accordingly, if the stock market is crashing but the fund's real estate is still meeting targets, your returns will be unaffected. Some of the cons are that private real estate funds have very limited liquidity. If you invest in a fund, your fund will stay in the fund until it sells all the assets, which is typically 5 or more years from your initial investment. You may be able to sell your shares in the fund to other investors prior to fund liquidation, but that is typically done at a discount to what shares are worth. If you're investing through an IRA and you don't need to get at the dollars that you're going to invest in a fund for 5 or more years, this can actually be, it's not necessarily a con, but it's something that everybody should be aware of before investing in a fund. Second, when you invest in a fund, you sign a legally binding commitment to invest a certain amount of capital, but the fund will not be able to deploy all of your capital right away. This is because the fund can't go out and buy all the assets it will buy as soon as you invest. As a result, you will have to leave the capital you have committed to invest in the fund in a liquid account so it is there when the fund calls for your capital. Your money is therefore not working for you right away as it would be in all other real estate investments. So essentially what this means is you're going to tell the fund, I'm going to invest $100 with you, and the fund says, great, we're going to invest that $100 over an 18-month period, and we're going to call $20 to $25 a quarter as we make investments in the fund, and then we'll pull your capital at that time. So during that 18-month period until the fund gets fully invested, you're going to have to keep that capital on the sideline, or at least if you leave it in the stock market, you're going to be subject to stock market swings. So you may want to keep it in cash or something that's pretty easily liquid for you to invest in the fund when they call your capital. Third, and like a REIT, investors still have no control over the assets that are purchased. Fourth, funds publish very limited information about themselves publicly. You therefore have to be willing and able to do your own diligence on the fund. Fifth, a lot of funds have large minimums of $1 million or more to invest, amounts that are outside the means of a typical real estate private investor who's investing as an individual.
Chris, I had one, if you don't mind, I got one quick question popped up, and kind of talking about private real estate funds. I think you're going to get into this in a minute, but someone asked, do you need to be an accredited investor to partake in a private real estate fund? If so, how does that work with a self-directed IRA? I mean, the second part of the question, I can just answer that client. Typically, if your IRA is making an investment and there's a requirement for an accredited investor, typically you qualify based on your own personal situation. and you simply use your own IRA to make the investment. As far as qualifying as an accredited investor, typically is based on the qualifications of the IRA owner as an individual. But like I said, the accredited investor question, I don't know if you want to take that now, or if you want to just, that's part of the presentation you're coming up, we can just delay it a little bit.
No, I can take it now. And the answer is yes, generally you do need to be an accredited investor to invest in private real estate funds or in single deal syndications, which is what we're going to talk about next. That's just part of the securities law requirements is, you know, if you're doing a private offering, you've got to make sure that your investors have the ability to sustain their money being locked up for a long period of time, and also make sure that if something goes wrong with the investment, the investors can lose their money, and the way to make sure that all that is copacetic is to make sure that all your investors are accredited investors.
And the accreditation, if I remember correctly, you have a net worth of $1 million excluding your primary residence, or you have a certain level of income over so many years. Is that correct?
Yeah, it's $1 million of net worth excluding your personal residence, or having, I believe they just changed the rules recently, but I want to say you have to have made $300,000 in each of the last 2 years. If you're single, and then it goes to $450,000, I think, with a spouse. But don't quote me on that.
That sounds close. And obviously, anyone who's listening, to the presentation, make sure you do your due diligence on that, or make sure you get that question answered. But I believe, Chris, you're probably on the mark there. So, all right. Well, let's talk about single deal syndications.
Great. Okay, we'll dive into that asset investment type next. So what's a single deal syndication? For starters, it's my favorite topic because it is what I do at my company, 4 Mile Capital. In a single deal syndication, investors invest directly with a sponsor. For each single deal syndication, a sponsor is raising equity capital to purchase one real estate property at a time. Occasionally, you might see a sponsor aggregating 2 or 3 properties, but generally speaking, they've identified one real estate asset they've put under contract and want to purchase. The process of raising the equity capital is commonly called a syndication, hence the term single deal syndication. You're buying one property or deal is being purchased by a sponsor who is syndicating the investment. Single deal syndications are similar to a sponsor investment fund, which we touched on earlier, except there is no fund. You invest directly with the sponsor, and therefore you don't pay any fees to a fund. Following our theme of starting with the most passive investments and getting more active with each opportunity we discuss, if you are investing in a single deal syndication with a sponsor, you have some work to do. First, you have to get to know the sponsor. What is the track record of the company and its principals? Do you know anyone who has invested with them? If so, what was their experience? Most importantly, do you trust them? You should feel very comfortable with the answers to all of these questions before investing with a sponsor. Second, you have to underwrite the opportunity. For each syndication, the sponsor will provide an investment memo that will outline the real estate they're purchasing, projected returns, an overview of the market where the real estate is located, and specific details about the real estate. As an investor, your job is to review that material, ask questions, and even do your own research to confirm if you agree with the sponsor's conclusions about the opportunity. Upon request, a sponsor will also provide the financial model they are using to calculate investor returns. If you're comfortable doing so, you should request the model and review the assumptions for yourself to confirm that those assumptions check out. Last, for every investment you make with a sponsor, you'll have specific legal documents that you and your counsel should review so you understand your rights and obligations as an investor, as well as the sponsor's rights and obligations. Sponsor fees for single deal syndications are similar to fund fees, but are still somewhat unique. The first difference between what funds charge and what sponsors charge is sponsors charge an acquisition fee of 1 to 2% of the purchase price of each deal they buy. The acquisition fee covers sponsor overhead and is charged because asset management fees are typically only 1 to 2% of property revenues, which works out to be just a few $1,000s per month. The acquisition fee is therefore what sponsors charge instead of the large asset management fees that funds charge. Like funds, sponsors are also paid a carried interest, though the percentage splits can be higher for the sponsor in single deal syndications because the nominal dollars a sponsor makes deal by deal are much less than a fund will make over the course of dozens of investments. By way of example, if the sponsor is using a single tier structure, the carried interest payable to the sponsor above the preferred return will be 20 to 30% of the profits. If the sponsor is using a waterfall, the structure will be similar to a fund, but splits can be higher for the sponsor, with some sponsors taking the splits inverted, meaning that after the investor achieves a certain IRR, typically of 20% or more, the sponsor will receive more than 50% of the remaining profits. So if an investor receives a 20% IRR, the remaining profits could flip so that the investor receives 40% and the sponsor receives 60%. It's not super common to see that, but it can happen, and we have seen it out there in the market. Turning now to returns, like with funds, single deal syndications also offer a preferred return. The preferred return is similar to a fund's in that it averages 7 to 8%. Some sponsors will offer above market preferred returns of 9 to 10%, with 10% being the max preferred return I have ever seen. Due to the increased work that needs to be done by investors, as well as the increased risk from asset concentration, we see minimum IRRs of 13% to investors, heading to 50% or more on very special deals. Average investor IRRs should be around 20 to 25%, though most sponsors will model more conservative returns of 15 to 17% net to investors and then shoot to hit 20% plus. The pros of investing in single deal syndications include, first, 2 to 3% better returns than funds and 5% plus better returns than REITs. Second, you finally have control over the asset selection, as you get to decide with each deal whether or not to invest. You therefore get to evaluate each specific piece of real estate and invest only in the opportunities you like. Third, minimum investment amounts are often less than fund minimums. Specifically, most sponsors will accept checks as small as $50,000. Fourth, you get to and should develop a personal relationship with the sponsor. With most sponsors, you have direct access to the principals, and you can build trust and confidence with them prior to investing. In short, it's a much more personal way to invest in real estate. On the other hand, like with funds, and perhaps even more so, there is little to no liquidity for your investment. Once you invest, your money stays in the deal until the deal sells. Second, because you're investing in one asset each time, there is no diversification for each investment you make. That said, this lack of diversification can be somewhat counteracted by the fact that minimums are lower, so you can still diversify by spreading your capital out over multiple deals. Third, you need to do your own due diligence on both the sponsor and each deal each time. Vetting the sponsor gets easier each time you invest with the same sponsor, but you should still ask how their investments are performing, what changes have happened at the sponsor's company since your last investment, and of course, you need to do your own due diligence on each real estate opportunity before investing. Do we have any questions on sponsor direct investment, Scott?
No, nothing pops up. But I get encourage anyone. We have a few minutes left, obviously, and then Chris is going to finish his presentation. But if you have any questions, get those typed in. I'll make sure we get to those before the end of the webinar today. So if you have other questions, just type them in, and we'll make sure we get to you.
Great. Okay, so let's turn now to our fourth and final type of real estate investment, single asset direct investment. Single asset direct investment is where you buy real estate yourself. No REIT, no fund, and no sponsor in between you and the deal. Just like when you bought your house, the investment is in your name, or generally the name of an LLC you own exclusively, or the name of your IRA. And examples of single asset investment are buying by yourself and then operating a condo, a single family home, a small office building, a small retail property, or an apartment complex of 2 or more units. Your role as a direct investor is substantial. First, you have to determine the type of real estate you want to invest in. Then you need to do market research to determine the geographical area where you want to invest. From there, you, perhaps with the aid of a broker, need to identify a specific property to invest in. You then have to evaluate the pros and cons of the specific property. Next, you need to understand what options you have for debt and run a financial model. And that is all before you even make an offer on the property. Ironically, despite all the aforementioned work, it is after closing on the purchase that the real work begins. As an owner, you're responsible for filling your property with tenants, conducting repairs and maintenance, collecting rents, keeping books and records, and much, much more. As a result, single asset direct investment is a very active investment. One of the most attractive characteristics of direct investment is you pay zero fees to sponsors, managers, fund administrators, etc. Since all of you are looking at doing self-directed IRAs, I can imagine that this probably appeals to many of you. All profits therefore flow directly through to you. The downside is you do all the work that your fees pay for in the other investment structures. While it is true you may still pay a real estate broker and you may still have to pay staff and or a property manager, you are paying these fees in all real estate investments, which is why I didn't discuss them with respect to the other structures. The returns you will achieve in a single asset direct investment can be extremely varied. In short, your returns will be as good as you are, or are not, at selecting properties and operating them. That said, if you're good at both of those fundamental requirements, your returns should beat each of the other investment types discussed in today's presentation because there are no fees and because there's great risk in buying an investment yourself. The potential upside is therefore commensurate with the risk you are taking. The pros of direct investment begin with the fact that you have the potential to make the best returns. Next, you have total control over your investment. From what property you purchase to how you run it and when you sell it, you make all the decisions. Last, your liquidity is actually better than any other type of real estate investment we have talked about today, with the exception of REITs. That's because you can choose when to hold and when to sell the property. You're still subject to market conditions on a sale, but ultimately you make the decision, not anybody else, and you should be able to create liquidity for yourself by selling the property inside of a few months in most markets. The negatives to investing directly in single assets include that your risk is very concentrated. You are investing in one asset that has just one or only a handful of tenants, so if something goes wrong with the asset, the location, or you can't get tenants, the investment is in trouble. Next, you have to do exponentially more due diligence before investing. Last, once you have made the investment, you play an active role in ensuring that it is run properly. That said, if you're up for the challenge, you may find that you enjoy direct investment, and if you are skilled in it, it will be a very rewarding investment for you. Well, that concludes my presentation, The Many Faces of Real Estate Investment. I'll now open it up to questions. If you care to follow up with me after the presentation for any reason, please don't hesitate to reach out at the contact information shown here. Thanks for attending, and good luck in your real estate investing adventures.
Hey, Chris, thanks very much. A great presentation. Again, I prefaced at the very beginning, it was a matter of learning. We do so many things at Advanta when we do our webinars and our seminars talking about single-family homes and that type of investment. I was glad you came in and kind of presented other opportunities that are out there, especially when people hear about REITs or they hear about private real estate funds and they kind of, how do those work, or it kind of seems a little scary to get into, but I think you did a great job of presenting that information. So again, we'll open up to some questions. So we have one here, and I'd again encourage anyone else to get your questions in here. We have a few minutes. This question popped up, I think, when you're talking about syndications. I think it applies kind of in general, maybe to syndications and also to maybe some of the real estate funds. What are 3 due diligence questions you would ask? If you were the investor looking to invest in somebody else's syndication, what are 3 kind of primary due diligence questions that you would ask?
So that's going to be really dependent on the specific type of asset that you're investing in. But I think high level, 3 things that we always look at when we're underwriting a deal, and therefore you should take a look at, is what are the rents that are projected to be achieved at the property that the sponsor is syndicating, and how do those rents compare to rents in the market in the immediate area? So if they're saying, hey, rents at this apartment complex today are $800 a month, and we think we're going to be able to take rents to $1,000 per month, you should be able to look around and see that other apartment complexes are achieving that $1,000 per month today or better, so that you know that those rents are attainable, or the sponsor should have a very good reason for why they think they can lead the market in rent rate. That's number one. Number two, you're going to want to look at the market demographics itself. So what type of population growth is there? What type of job creation is there? What are the main drivers for that economy? Is it an economy that is a one-trick pony like Colorado used to be in the 1980s, where we were an oil and gas economy? Or is it like Colorado today, where we're a pretty well-diversified economy and have multiple sectors that are fueling our growth? And then the third question I would ask is, what is the capital allowance for the project, and is that going to cover all the capital expenditures that need to be made? So a lot of times what you'll find in sponsor syndications is we have identified an asset that's older, 1970s, 80s, or 90s vintage, and we're going to improve that asset, and we're going to, we may drop $500,000, it may be several $1 million into the asset in order to rehab it and improve it. So, has the sponsor checked on the roofs and made sure that the roofs are in good shape? Are the parking lots in good shape? If there's siding on the building, is it in good shape? Have they had an engineer out there to inspect the property? What issues did they find during their initial inspection, and what issues are they finding during their due diligence? And do they have enough capital to pay for all the required repairs?
Right. Thanks for those good questions. We had someone ask, I just want to make sure I address the question. Some of the other investment opportunities with your company, Chris, I'm sure that there are. I just want to make sure this webinar that we do is educational in basis. If you want to pursue any other potential investments, please just contact Chris directly. I'm sure he does have investment opportunities either on the horizon or maybe some available now, but that's not something that we do in a webinar. And again, Advanta doesn't necessarily endorse any investment or investment people that you're working with. So I'll make that clear. That's why we have Chris's information up for you to get a hold of him. Someone asked, what about tax implications for the IRA investing in leveraged deals? I could take that one. If your IRA makes an investment where there is leverage involved, you can subject your IRA to what's called unrelated debt financed income tax. Some people refer to it as UBIT. It's the same type of tax. But that is something to be aware of. If your IRA is investing into a syndication, or if someone asked, what if I use my IRA just to buy a single family property with leverage, your IRA will be subject to that UDFI tax. The UDFI is the trust tax rates, and it does depend greatly on how much leveraging is involved. If your IRA, for instance, was buying a single family home and you put down 40% from the IRA, and your IRA borrowed the other 60%, then 60% of the income the IRA receives will be subject to that tax. The other 40%, based on the equity you have in the property, is not taxed and comes back to the IRA. That's definitely a situation where you want to get a CPA or a tax advisor if you're going to potentially have leverage either on a single-family home deal or if you're getting involved in a syndication or a private placement to get those questions answered. Having to pay tax in the IRA is not prohibited. There are some things you can't do in an IRA account. Doesn't mean you can't make an investment if there's leverage. Just means you need to factor in that tax. And that tax does apply to the IRA, not to you personally. So your IRA files a separate tax return, and then the IRA would pay any tax that may or may not be due. One person asked, what are the tax implications of the various types of real estate investment options? And it may be kind of a really broad topic for us to get in. I know, again, within an IRA, other than if there's no leverage involved, your IRA has no tax implications. If you have personal property held, then obviously you're going to have some tax implications on an individual basis, but then you also will get depreciation and other deductions that don't typically apply to an IRA, again, unless there is leveraging. Chris, any thoughts on that? I mean, again, the question is kind of just what are the tax implications of the various types of real estate investment options?
Yeah, I mean, I think you're right on that. It's really we could do another hour webinar on the different tax implications for each type of the investment structures. I think generally speaking, one of the reasons that a lot of our investors like investing in real estate deals is because, as you touched on, you get the advantage of depreciation and amortization driving down your net income, your net taxable income, I should say. So, depreciation and amortization, if you're getting a 10% return on your money in the first year or two, depreciation and amortization can actually wipe out that entire 10% from a taxation standpoint. So you can wind up paying zero tax on that 10% distribution that you might receive or 10% dividend. But they're all each investment's different. Each situation is different for each investor, and so I think you would need somebody who's much more well versed in tax matters to, I think, speak to that specific question and answer it appropriately. And I think, like Scott said, the best thing to do is contact your CPA for each investment that you're considering making and understand what the tax implications are for that particular investment.
Yeah, well, let's see. We had one other question pop up here. We jump to the last slide here in our presentation. It says, do you need to be a qualified investor for single deal syndications? And I guess, I don't know if that's more of accredited. I know there's accredited, but sometimes there's also a sophisticated investor qualification. Maybe just touch on that for a minute if you can, Chris. Do you need to be qualified investor for a single deal syndication?
Yeah, so you'll need to be qualified in some way, shape, or form. If you're a sophisticated investor, as Scott said, that can be one way. If you don't quite meet the accredited investor requirement, that can be a way for you to invest in a single deal syndication. But that being said, it's going to depend on the sponsor or syndicator's requirements in terms of whether or not you can invest with them. And generally what I see is, as a sponsor, we require that everybody be an accredited investor. And the only time we'll make an exception to that and allow a sophisticated investor is if it's somebody that we have a personal relationship with and have gotten to know well over the years. It could be a family member, it could be an employee or a former employee. And so we've made exceptions for people like that. So if you know a sponsor personally or get to know a sponsor personally, there's a good chance that they'll make an exception for you. And there are other sponsors that will take non-accredited investors if you can meet the sophisticated investor requirement. But as a former corporate lawyer who did a lot of security stuff, it honestly scares me to take non-accredited investors. So we restrict our investors to having to be accredited.
Well, and Chris, offhand, as far as REITs go, like the publicly traded REITs, do they have some of the same qualifications or accreditation standards to invest in those, or are those treated more like just stocks, or if you have the right type of brokerage account, you can just directly purchase that asset?
REITs are, like you said, they're treated like stocks, and so if you want to invest in a REIT and you don't meet the accredited investor requirements and want to invest in real estate, REITs are a great way to go because you don't have to meet any accredited investor requirements. The accredited investor requirements is purely for private offerings. So you could also, I guess, kind of bookending the presentation, if you're not an accredited investor, you could invest in a REIT, or you could go buy an asset by yourself as a single asset direct investment. So those are the two options that you have that are for sure you do not have to be accredited to do either of those. And then whether or not you can invest in a fund or a sponsor single asset syndication, it'll depend on the circumstances of the fund or the sponsor.
All right. Well, Chris, we're a little over time, but great information, great questions. I want to thank you very much again for coming on. And Chris's information was up earlier a few minutes ago in the presentation. We will be sending a recording out to everyone who registered. Even those of you who attended live, you will get a copy of the recording to go back and listen. for playback. So I want to thank everybody for attending. Chris, thank you very much again for your time today.
Thank you. Thanks for having me, Scott, and thanks to each of the participants for taking time out of your busy schedules to hear Scott and I speak to you today. We really appreciate it and are grateful for your time.
Very good. Thank you very much, and I encourage everyone to go to our website or look out for our next upcoming webinars and events that we have, and we look forward to talking with you again.